Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending June 10, 2022. Looking at the indexes for the week, the TSX, Russell 2000, S&P 500, NASDAQ, and Dow Jones were all down after a down week, punctuated by a very bad Friday. Oil and gold were up once again for the week, gold especially on Friday because of the fear. The big news event was that the US CPI report came out on Friday and it came in at 8.6% year over year inflation for May. This was higher than hoped for because April was 8.3 year over year, breaking the downward trend. The market sold off heavily on Friday as a result because further rate hikes are expected, perhaps even a 0.75% rate hike in the US next week, and the more of a danger of a recession or stagflation is being priced in. The US May jobs report came in stronger than expected at 390,000 new jobs. The US jobs market remains strong, but there are signs that a welcome moderation, which should help cool off inflation pressures, is in the making. The Labor Department reported on Friday that the United States economy added 390,000 jobs in May, which followed an increase of 436,000 jobs in April. The US weekly jobless claims rose to 229,000, however. The unemployment rate held steady at 3.6% in the US. The jobs report confirmed the picture that has been emerging in recent months. Job growth is moderating to a slower but healthier pace, and wage growth is following at a slower pace. A slower job growth doesn't mean the recovery is over, but instead that the recovery is shifting to a more supportable pace, helping to keep the economy from overheating. Note that even if the US or Canada fall into a recession, the market will be recovered by the time the recession ends, since the market is forward looking. A down market can last even 1 or 2 years, but 30% of the recovery happens in the first 30 days in the US markets, so it is important to stay invested and take advantage of the rebound. Looking at Canadian interest rates, the Bank of Canada is at 1.5%, and the bond market has priced in 3% interest rates by October. So we may get 3.5% rate hikes or even a 0.75% in the next meeting in July. The expectations of Bank of Canada being aggressive and rushing the hikes to squeeze demand out of the market and to drive demand out of the labor market as well. Canada added 40,000 jobs in May on Friday, which is inflationary and was above expectations. There is lots of job openings, which raises wages. The rising price of oil is not near creating demand destruction, turning to oil. This would likely happen at a $150 barrel of oil. There isn't much that can be done on the supply side, and so demand will have to come down as price goes up. As the Chinese demand for oil returns, oil prices are still increasing. OPEC is struggling to produce more, and the summer driving season is coming. Ramping up capacity is a long-term endeavor taking 1 to 5 years. The $150 barrel of oil is not out of the realm of possibility, and that would finally slow down demand. We had a report from the World Bank, and they lowered the world growth forecast to 2.9% overall and warned of stagflation. Looking at North America and Canada specifically, a recession isn't my base case because the strength of the job market and economy has momentum. Supply issues are getting better and will lower inflation, and Target even warned about its inventory being too high and needing to get rid of some at a discount. Auto inventories will improve in the next 6 to 12 months as car manufacturing recovers. And even with oil going to $150 per barrel, while a drag on the economy, likely wouldn't cause a recession on its own. Some experts think that central banks have to take the economy into a recession to lower inflation. Again, that's not my base case. In the markets, there is an overall earnings increase expectation of 5 to 7% for 2022. That's lower than usual, but it is still showing earnings growth. Banks will continue to do well with rising interest rates as their margins improve, and the danger is a recession or a flattening or an inverting of the yield curve once again. In the markets overall, earnings expectations are up, and the lower prices are being caused by a PE multiple contraction rather than by poor earnings. Consumers are switching from goods consumption that was all they could do during COVID lockdowns to experiences and service consumption now that they have the services available, especially travel. The European Central Bank this week left its rates unchanged and said they would raise them in July. Europe has significant inflation as well. Looking at next week, the earnings season is pretty much over with only Adobe reporting earnings on Thursday. Next week's economic events include on Wednesday, we have the US retail sales are being reported, and the US Fed central bank interest rate decision is being announced with a 0.5% hike widely expected and a 0.75% hike on the table, especially with the US inflation still on the high side, as I had mentioned. On Friday, Canada has industrial production price index announcements. That concludes my thoughts for the week. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.